significant transaction in the general insurance space. We told you first, and now it's true. HDFC buys controlling stake in Apollo Munich Health Insurance. Nisha Poddar, who earlier broke the story, gets us the details.
HDFC Limited has beefed up its health insurance business by an acquisition of the controlling stake of Apollo Munich Health Insurance, and the total cash consideration for this transaction for the controlling stake of 51% is about 1,346 odd crore rupees. Now remember, it's Apollo Group, Apollo Hospitals Group, which has sold its 51% stake in the company, while Munich, which is also, remember, Ergo as part of the global group, really stays on in this particular joint venture. So what really happens is that it's a two-stage transaction. First, HDFC Limited buys it out in cash deal, and then HDFC Ergo, which is the health insurance arm, then merges this company with itself. So all in all, with Munich as well as Ergo being part of the same global group, continue to own about 49% stake in this joint venture, and 51% stake is with HDFC. It's part of the plan to beef up the general insurance business, looking at a future IPO, which could be after 2 odd years after enough business has been created and value creation has been done. Now this is an important transaction for Apollo Hospitals Group in particular, because they are getting 2 tranches of amount, 294 crore rupees from Munich as their erstwhile partner, and 1336 crore rupees is coming in from HDFC Limited. Now remember that a large part of this cash component is likely to be utilized by Apollo Hospitals Group to reduce their pledged shares, which is 68% of their total holding in Apollo Hospitals, to about 50%, and that could really give a big relief to the market participants about Apollo Hospitals. Also, some part of the money can go in the listed company as free cash flow or for debt reduction.
In fact, Nisha also caught up with Sunita Reddy, Director of Apollo Munich Health Insurance, and began by asking what the valuation drivers for this transaction were. Listen in.
6 times invested capital, which I think is a very good valuation.
All right, and why an exit at this point? And it is complementary to your overall business. So are there going to be any relationships with the acquirer as well going forward, which could be complementary to both the groups?
Yes, I think, our deep understanding of healthcare and the fact that we've also built channels, we've created access points, so those will continue. And in terms of HDFC and Apollo, we've had a long-term relationship.
Right. What also market wants to know from you is the way this proceed is going to be utilized by the group and the company in terms of debt reduction. That is one aspect, and in terms of releasing the pledged shares by the promoters. Can you throw more light on that, because you're getting close to about 1,340 odd crore rupees minus tax. All that amount and its proceeds is something that we'd like to know your utilization.
So in terms of Apollo Hospitals, this will, immediately it'll probably cut down the debt, but more importantly, it will create free cash flow for us to invest into maybe a new acquisition, but clearly it's about creating free cash flow and an important value accretion event for all the shareholders. Right. On a personal level, yes, if you look at our PCR promoter shareholding, it will bring down our debt significantly. We believe that from the current 68, we should look at another 30% reduction. It could go to below 51%.
Below 51%. All right. So you are saying that from 68%, if you are cutting down your pledged share and releasing it by 50%, you had earlier guided that you will reduce it by 50%. So all your work towards pledged share release at the moment is really met. Are those targets met with this transaction?
All our targets, it will take 1 year for us to meet the entire target. So we believe that 50% of our target will be achieved with this. We will have very low leverage on our personal balance sheet if you look at us 12 months out.
All right. And on the listed company, what is the debt amount which it can reduce by?
That's not really significant. Our debt to EBITDA is, debt to equity is 0.83. So, 300 crores going into Apollo Hospital. I don't think it's more about creating free cash flow. It will deleverage the balance sheet. It will serve twin objectives.
All right. And in how much time do you expect this money to flow into the company?
It should, considering the due process, IRDA approval, CCI approval, it should take 90 days, I believe.
All right. We also spoke with Ritesh Kumar, who's the MD and CEO of HDFC Ergo, to get a perspective on how this acquisition will drive growth for the company.
The entire transaction is being envisaged in a two-stage process. So in stage one, HDFC goes out and buys the 51.2% stake of the Apollo family, as also some employees in the company. So in stage one, the entity, i.e. Apollo Munich, becomes a subsidiary of HDFC. Immediately thereafter, we file with, and this is of course subject to all the regulatory approvals of the National Housing Bank, and which is HDFC's regulator, the IRDAI and the Competition Commission. In the next stage, post the closing and the entity becoming a subsidiary, we then go out to the NCLT for the merger. And subsequently the final approval of IIT. So it's really going to be in a two-stage process. Okay. First as a subsidiary of HDFC after acquiring the shares, and subsequently a merger into HDFC.
Okay. As Mr. Parekh also mentioned, how the health portfolio is growing subsequently for all the general insurance companies. What is the rationale behind merging it with HDFC Ergo and not keeping it health insurance separate standalone subsidiary and transferring the business, the health business which Ergo also has, into that standalone subsidiary?
So as I mentioned earlier, on a combined basis, if we just do a simple addition, the combined market share on health and accident for the two entities becomes about 8.2%. Okay, the rationale or a decision whether to sort of keep it as a separate entity or merge has basically been driven by the synergy considerations. We feel that there are sort of significant synergistic values which we can get sort of out of the merger, and that is what has driven the thought process.
One last question as far as the key financial aspects are concerned. As far as the merged entity is concerned, HDFC Ergo into Apollo Munich, what will be your solvency, the merged entity? What will be the combined as far as the two entities are concerned, and how profitable would the entity be, and the premium growth as well? What kind of industry scenario do you see in that sense?
See, the combined ratio of HDFC Ergo last year was 98.9%.
Correct.
The combined ratio of Apollo Munich was 100.7%.
Correct.
So if you were to basically sort of add these up, in any case the combined entity has a two-digit combined ratio.
Correct.
So going forward, we only look at that strengthening and the combined ratios being better. The other question that you asked was on solvency. Our solvency is about 1.74, 1.75. The solvency on a merged basis, sort of at the end of the, so as of March 19, the solvency of Apollo Munich was 1.63%.
Correct.
Okay, so the merged solvency becomes something like 1.7372 as of March 19. I mean, in future basis, the growth, there would be requirements which would be there. And things would move forward on.
Do you expect a fund infusion considering the solvency and the growth which you expect from HDFC in the next 2 years?
So, right now HDFC is investing by putting in the money to buy the shares. Also, any capital requirement that the company would have in the near term till the merger is effected would be made good by the new set of shareholders, i.e. HDFC and Apollo and the Munich Group. Subsequent to the merger, on the present basis, we do not foresee any additional requirement of capital.
Alright, it's time for a quick break. Up next, as a part of Jet's revival